You own 100 shares of Apple. You bought them at $170. Apple is now at $182.50. You are sitting on $1,250 of unrealized profit, and earnings are in 2 weeks. You do not want to sell. You believe in the stock long term. But you have watched earnings wipe out months of gains before. One bad quarter, one cautious guidance, and Apple is at 160 overnight. The protective put is the answer to that problem. It is insurance for your stock position, a put option you buy that gives you the right to sell your shares at a fixed price, no matter how far the stock falls. You define your maximum loss before the event happens. The stock can crash to zero. You will not lose more than you agreed to pay for the protection. This video covers exactly how it works, when to use it, and what it costs. The protective put has 2 components, and you already know both. Component 1. You own 100 shares of the underlying stock. This is the position you are protecting. Component 2. You buy one put option on the same stock at a strike below the current price. This put gives you the right to sell your shares at the strike price, regardless of where the stock actually trades. The put acts as a floor. No matter how far Apple falls, you can always sell your shares at the strike price of the put. The premium you pay for the put is the cost of the insurance. Think of it like home insurance. You pay a monthly premium. If nothing bad happens, the premium is spent, but you did not want the bad thing to happen anyway. If something bad does happen, the insurance pays out and your loss is capped. The protective put works the same way. The premium is the cost of peace of mind, with a mathematically defined payout. You own Apple at a cost basis of $170. Apple is currently at $182.50, an unrealized gain of $1,250. You buy the 175 put, 45 days to expiry, at $2.50 per share, costing $250. Now consider what you have. If Apple falls below 175, your put gains value dollar for dollar. At 160, the put is worth $15, a $12.50 profit on the put that offsets much of the stock's decline. At any price below 175, your effective exit is 175. The put lets you sell at the strike. Your maximum loss from the current price of $182.50 is $7.50 of stock decline to the strike, plus the $2.50 premium paid, $10 per share, $1,000 total. No matter what Apple does, your maximum loss from here is capped at $1,000. Without the put, a crash to 160 means $22.50 per share in losses, $20 to $150. Strike selection for the protective put is about choosing your floor, how much downside you are willing to accept. Higher strike, closer to the current price. More expensive premium, but tighter protection. A 180 strike on Apple at $182.50 costs more, but caps your loss to just $250 plus premium. Lower strike, further below the current price. Cheaper premium, but you absorb more of the decline before the protection activates. A 170 strike costs perhaps $1.25, but you absorb $12.50 of decline before the put kicks in. The right strike depends on your objective. If you are protecting a specific gain, like your $12.50 profit, choose a strike above your cost basis. The 175 strike keeps you profitable even if assigned. If you just want catastrophic loss protection, a hedge against a crash, a lower strike at lower cost may be enough. Most traders protecting unrealized gains target a strike near or slightly below the current price, accepting a small defined loss in exchange for protection against a large one. Expiry selection for the protective put is driven by the threat timeline. If you are protecting against a specific event, earnings in 2 weeks, you need at least enough days to cover that event with some buffer. A 45-day put covers the earnings report and any follow-through movement with 30 days to spare. If you are protecting a long-term position against general market uncertainty, a longer-dated put, 90 to 180 days, costs more, but provides extended coverage without needing to roll every month. One critical difference from the income strategies you learned in videos 8 through 10. As a put buyer here, theta works against you. Every day the put loses value. You are paying for time, not selling it. This means you want to use only as much time as you need, not more. Do not buy a 1-year protective put for a 2-week earnings event. Match the expiry to the risk window. Overpaying for time you do not need is a common and costly mistake. Here is the real trade. Apple at $182.50. You own 100 shares, cost basis $170. Unrealized gain, $1,250. Earnings report in 2 weeks. Binary event with meaningful downside risk. You buy the 175 put, 45 days to expiry, protecting above your cost basis and covering the earnings window with room to spare. The bid is $2.30. The ask is $2.70. Mid price, $2.50. You buy one contract at the mid, $250 total cost. What you now have, a hard floor at $175. Your maximum loss from the current price is $10 per share, $7.50 of stock decline, plus $2.50 premium. Your cost basis is protected. Even in a worst case, you exit at $175 and retain a $5 per share gain on the stock above your $170 entry. The insurance costs $250. The risk it removes is potentially $2,000 or more. On the options chain, navigate to the 45-day expiry and go to the put side. At the 175 strike, bid $2.30, ask $2.70, mid $2.50. Delta, negative 0.35. As a put buyer, this negative delta tells you the put gains 35 cents for every $1 Apple falls. If Apple drops $10 to $172.50, the put gains approximately $3.50. Implied volatility on this strike, 26%, slightly elevated ahead of earnings. You are paying a small for premium. That is the cost of buying protection into an event. Volume, 940 contracts. Open interest, 2,380. Liquid, you can exit the put cleanly if you decide to close the hedge early. The order, buy to open, one contract, 175 put, limit at $2.50. Filled in under a minute. Protection is in place. The profit and loss diagram for the protective put. Horizontal axis, Apple's price at expiry. Vertical axis, combined P&L on stock plus put. Above the strike of 175, the stock gains are yours, reduced only by the $2.50 premium paid. The P&L line slopes upward normally, shifted down by the cost of the put. At $182.50, flat, you are down $250 from the premium only. Below 175, the P&L line flattens. The put activates and offsets stock losses dollar for dollar. The floor is 175 minus the 250 premium, an effective floor of 172.50 on your total position. Key levels, maximum loss from current price, $1,000. Break even on the upside, 182.50 plus 250 premium cost equals 185. Above 185, you are in net profit on the combined position. Without the put, there is no floor. The stock can fall to any level and the loss compounds without limit. The cost of protection and why it matters. The $250 premium is not free. It is a real cost that reduces your net return. If Apple rises $20 to $202.50, a fantastic outcome. Your stock gains $2,000. But you spent $250 on the put, which expired worthless. Your net gain is $1,750, not $2,000. You gave up 12.5% of your upside gain to buy the insurance. This is the trade-off every insurance buyer makes. Additionally, the put loses value every day due to theta. If the threat passes, earnings come and go without disaster. The put decays toward zero. You spent $250, the risk event passed, and the insurance expired and used. That is the ideal outcome. You paid for an outcome that did not happen. This is not a loss. It is the cost of removing the risk of a much worse outcome. Professional portfolio managers routinely pay 1 to 2% of portfolio value per quarter on protective puts. The cost is the fee for sleeping at night. Scenario 1. Apple rises after earnings. Apple reports strong results and moves from $182.50 to $195, a $12.50 rise. Your put, with a strike of $175, is now deep out of the money. The stock is far above the strike. The put is nearly worthless. At expiry or close to it, the put is worth approximately 10 cents. You can sell it for $10, a token recovery. Your combined result, stock gain $125 on 100 shares, $1,250. Less put premium $250, plus residual value $10. Net gain, $1,010. Without the put, you would have made $1,250, $240 more. You paid $240 net for insurance that was not needed. The stock performed. The insurance was the right decision at the time it was made. You could not know earnings would be positive. The protection was in place for the downside that did not materialize. Scenario 2. Apple falls to the strike at expiry. Apple misses earnings estimates. The stock drops from $182.50 to $175, a $7.50 decline, over the next 3 weeks. Your put is now at the money. The put has intrinsic value of approximately 0, but retains some time value with 22 days remaining. You have 2 options. Exercise the put. Sell 100 shares at $175, exiting with a $5 gain above your $170 cost basis. Net of the $250 premium paid, a $250 per share profit, $250 total. Or hold the put as the stock may continue falling. If the earnings miss is temporary and the stock recovers, you lose the remaining time value but keep your shares. This is the decision point the protective put gives you. You are not forced to sell at a loss. You choose what happens next. The floor is in place. You have time and optionality that an unprotected shareholder does not have. Scenario 3. Apple crashes. A major negative event. Not just a bad earnings report, but a product recall, a regulatory ruling, or a broader market crash. Apple falls from $182.50 to $145, a $37.50 decline over the 45-day window. Without protection, your loss on paper is $3,750, a 30% drawdown from current price, turning a $12.50 unrealized gain into a $2,500 loss below your $170 cost basis. With the protective put, the put is worth $30 at expiry, a $27.50 profit on the put, against a $37.50 loss on the stock from the current price. Net combined loss, $10 per share, $1,000 total. Your cost basis is not breached. The put protected every dollar below $175. The $250 insurance premium prevented a $2,500 loss turning into a catastrophic position. That is the protective put doing exactly what it was designed to do. When to use the protective put, and when not to. Use it when you hold a significant unrealized gain and a specific risk event is approaching. Earnings, a central bank decision, sector-specific news. You want to remain invested in a stock you believe in long-term, but cannot afford to let a short-term event destroy months of gains. You are in a concentrated position. One stock represents a large portion of your portfolio. The peace of mind has real economic value. You do not want to sell and re-enter, avoiding tax events or transaction friction. Do not use it when implied volatility is already elevated and the put is expensive. You are buying insurance after the fire has started. There is no specific risk event. Using protective puts as a permanent hedge on every position is expensive and will drag long-term returns significantly. You would be better off simply reducing position size. The stock is in a long-term uptrend with no near-term catalyst. The premium cost compounds against you over time. The protective put is a targeted, event-driven tool, not a permanent state of portfolio management. The complete protective put on one page. Stock position, 100 shares of Apple, cost basis $170, current price $182.50, unrealized gain $1,250. Risk event, earnings in 2 weeks. Put bought, 175 strike, 45 DTE, at $2.50, $250 total cost. Delta, negative 0.35, 35 cents of put gain per $1 of stock decline below the strike. Maximum loss from current price, $1,000, $750 of stock decline to strike, plus $250 premium. Effective floor, $172.50 per share on the combined position. Upside, unlimited, stock gains above $182.50 kept in full, net of the $250 premium. Break-even on combined position, $185. Scenario 1, stock rises. Put expires, net gain reduced by $250 cost. Scenario 2, stock falls to strike. Exit at $175, retain $5 gain above cost basis. Scenario 3, stock crashes. Put offsets all losses below $175. One position. Complete protection defined before the event. Here is what you now know and can now do. 1. The protective put is insurance for your stock position. You buy a put that gives you the right to sell shares at a fixed price regardless of how far the stock falls. 2. The put strike is your floor. Choose it based on how much downside you are willing to accept before the protection activates. 3. Match the expiry to the threat timeline. Only pay for as much time as you need. Theta works against you as a buyer. 4. The premium is the cost of insurance. It reduces upside if unused and pays out precisely when needed in a decline. 5. Use it for specific risk events, earnings, macro decisions, concentrated positions with large unrealized gains. It is a targeted tool, not a permanent hedge. 6. The protective put gives you something no other position can: the ability to remain fully invested in a stock you believe in, while mathematically capping your maximum loss before the risk event occurs. That is video 11 complete. The next video covers the bull call spread, a way to take a directional position with defined risk and significantly lower capital than buying a single call outright.